One is ETFs. ETFs are similar to mutual funds but slightly different. So what is the key difference between the two, or what are ETFs? ETFs are exchange traded funds. An exchange traded fund is a type of security that involves a collection of securities such as stocks that often tracks an underlying index. Although they can invest in any number of industry sectors or use various strategies, ETFs are in many ways similar to mutual funds. However, they are listed on the exchanges, and ETF shares trade throughout the day just like ordinary stocks. So, the other thing I forgot to mention about mutual funds is mutual funds are very exclusive. In other words, the only way you can get a mutual fund is if you go to, like, Vanguard has specific mutual funds on its site. You can't just track or buy into a Vanguard mutual fund. You can't just track or buy into a Charles Schwab mutual fund. Mutual funds are very much determined by whoever the portfolio managers are, and they are not traded publicly on any markets. They're not traded. You can't just go and buy into it. Unlike an ETF is just available publicly. It's a good way to hedge your bet. A good determination of what an ETF is, it's kind of like a stock. It's kind of like the in-between between a stock and a mutual fund. It looks like a mutual fund, but it trades like a stock. In other words, it has a bunch of companies under one name, and that way, just like a mutual fund, you never have the high highs or the low lows that you will see when it comes to trading on the stock market, which is what a mutual fund does for you as well. However, the good thing about ETFs is they are much, much, much cheaper than mutual funds because they are passively managed, where mutual funds are usually very much actively managed. So when I say passively managed, it just means like they just select a bunch of companies from an index. For example, if you have a mutual fund, I have one pulled up here. It's called the Schwab Strategic Trust. And basically this mutual fund, I said mutual fund, my bad. This ETF is basically mirroring what happens on the Dow Jones index. It selects companies within the Dow Jones and says, hey, I want this company, that company, this company, that company. And these are the companies that we'll use to track the Dow Jones index to maybe beat or perform exactly like the Dow Jones index. So that's the idea of mutual funds. Of ETFs, which ETFs are also a wonderful way for individual investors to invest in the stock market. It's a good way for you to invest passively. I would advise that most people, if you're investing and you're listening to this and you're not exactly keen on learning every little bit about the industries and all this other stuff to know what companies to select, what companies not to select, I will say invest in ETFs. ETFs are your best bet. Don't even worry about looking at individual companies. Just look at ETFs, because that way you're not seeing any of the losses. You can see the beneficial things. And there's some great ETFs out there. You have the SCHD that I mentioned earlier, which is the Schwab Strategic Trust. And then you have a bunch of good ones from Vanguard. You have some good ones from Fidelity. You have all kinds of really good ETFs. You just have to do your research and find some really good ones. Some of the ones that I like are SDY, SPY, SCHD, XLK. These are all, I'm just saying all these names out loud. You can go back and look these up later on. And just, those are some really good ETFs. But for individual investors, or for somebody who you may already have a mutual, for example, for me, for my IRA, I already have an IRA where it's professionally managed by somebody who looks over it and determines all that good stuff. So it's basically invested in a bunch of mutual funds. But on my own, doing Robinhood and M1 Finance on my own, I'm invested in a couple of ETFs as well. For example, I talked about that gamer ETF earlier. Or for example, another one that I want to buy is this SCHD ETF as well. So it's a good way to hedge your bet, and it's a good way for you not to waste your money when you're investing. It's just a safer bet. I would say most people who are listening to this are not going to spend a whole lot of time looking into companies, looking into how a company is doing, learning more about if a company is going to do well or not. You won't see the same returns as somebody else who invested in a company, but however, you also won't see the same losses of somebody who invested in a single stock, if that makes any sense. And of course, there are a bunch of different types of mutual funds. ETFs. There are ETFs that track the S&P 500. There are ETFs that are designed to kind of compete against the S&P 500. And basically, it's called an inverse ETF, where they profit based off if the S&P 500 or the NASDAQ or Dow Jones kind of have a decline. And then you have all kinds of different ones. You have foreign markets, commodity ETFs. Basically, these, and the other good thing about ETFs is they are very highly specific. You can get as specified as you want when you're looking at an ETF. So you can look at, if you wanted a high dividend paying ETFs in tech companies only, there's probably an ETF out there, where a mutual fund probably won't have that. But ETFs, you can have ETFs where it's like, I want gold ETFs with some corn in it and some tech companies. There's an ETF out there for you. There's a lot of specific ETFs are very specified, just like the gamer ETF, where it's literally focused on gaming companies. It's literally focused on just the gaming industrial companies. So that's something to think about with ETFs. It just allows you to track things a lot easier. You don't have to research every single company. All you have to do is research that one ETF that may have over 100 companies. For example, like this Schwab ETF that I keep talking about, it has 100 companies within it. It has companies like Home Depot, Exxon, Intel, Pfizer, Pepsi, Verizon, Coca-Cola, really good companies as well. And plus, it shows you different industries. It shows you different parts of the stock market industries. It's not just invested in one thing. It's invested in multiple different industries. So if one industry is doing bad, you don't see that negative. Rather, you see the cumulative aspect of the good and the bad, rather than seeing like the 100+ gain and the 100+ loss, if that makes any sense.